Welcome to the March 2021 Column E Advisors Review of Markets. In this video, we will cover the current market picture, how this impacted strategies, and our quick outlook going forward. This market currently features is very one-sided trade, with the trend followers and the momentum traders benefiting very much. Down trades against this trend following strategy have been very short term, 1 to 2 days often and no more. This has emboldened the buy the dip crowd to be even more aggressive and push markets higher. FOMO is also very much alive as intraday trading patterns show large candles to the upside as investors see the move coming and they all jump in, pushing markets higher. This has also been seen on the downside as the 1 foot out the door market continues to develop. A 1 foot out the door market is when investors get less confident about the upside of the trade, trail stops closer, and this leads to large falls in momentum of the trade and sell-offs to the downside. The most recent one being last week of March, when margin selling impacted the S&P and pushed it down about 75 points into the close on a Thursday, followed by additional selling on the open the following day, and then a 100-point rally panic FOMO move. How this impacted the portfolio? Being a contrarian has not paid to be against this market. One-sided trades that go up and do not feature very little movement to the downside often lead to losing trades. That has hurt our performance. Second, risk management was not beneficial this month. Our sentiment models, which have been very good over the time, have not benefited this quarter. Sentiment was extreme through the end of February and January, and in both cases we saw higher prices the following month. Risk management is continuing to be on the portfolios going forward, as we do expect some sort of down trade to develop. However, sentiment has moved back to neutral at month end, interestingly enough, even as markets climb. Finally, the month end sell-off in options was interesting in that our positioning in call options and trend following instruments were in profitable positions relative to the S&P, but premium dropped out of call options at month end, causing us to lose performance there as well. Finally, in terms of our outlook, we expect a two-way market to develop, especially with the VIX falling under 20. As the VIX falls to normal levels, this will encourage trading on both sides of the trade among traders, among portfolio managers, in a more tradable environment. Trend following will be less advantageous as a result. We also expect risk taking on to balance. Right now it is very imbalanced, moving to the upside. In similar fashion, 2010, when the PE compression developed in the S&P 500, we expect the same thing. So far that has not formed. Our biggest risks to the outlook are inflation overshoot. We're starting to see that in real goods, core goods. We're seeing that in energy prices. We'll see how far that develops. Second, our second risk is a bigger drop in PE. If the PE of the market falls in similar fashion to 2005, that will impact the overall returns of the S&P and push it back towards a 0 to negative return for 2021. 2005 was not the best trading environment. 2010 was a better trading environment. Those are the ones we're looking at. Thank you very much for watching the latest installment of the market review from Column E Advisors. If you'd like more information on Column E Advisors, please visit columne.com. Please read our blog Between the Columns, and if you wish to reach out, this is Brendan McCarty, CIO of Column E Advisors. Thank you very much.